Welcome to another Southbank Investment Bulletin. Well, the FTSE 100 is at a new all-time high, and this is a big deal. Now, let's just remember that back in 1999, early 2000, the market peaked at 7,000, and it's now at 8,000. Now, that's a gain, but there's been an awfully long time since the FTSE 100 has been something that attracted investors who really wanted to make a lot of money. And I think if we just look at the choppiness of the pattern over the last 23 years, then the only conclusion one could really come to is that it was a trader's market, that there were multiple 1 or 2 year trends, and some were up, some were down, and that the only way to participate was on a short to medium term basis. Now let's just contrast this. Now what I want to do here is I'm going to put up what's called a logarithmic scale chart, and I'm going to look at it monthly. But now what this does is changes the scale. So now the gains here are in terms of percentages, and then let's just zoom out. So now we can look at the big bull market that started in the early 80s, and the market went from 1,000 to 7,000 over that 17-year period. Now that was a truly spectacular rally. And then what we could really call all of this in the FTSE 100 would be what's called a secular bear market. In other words, it's a generational long process of PE ratio contraction and rising dividend yields in an environment where we've had a lot of growth companies doing very well. The PE on the FTSE 100 has dropped down to just less than 11 on a forward basis, and has a yield of 3.5% right now. Now I want you to just simply look at the NASDAQ 100 and on the same basis. So it has a PE of 26 and it has a yield of 0.87. So obviously the NASDAQ over, and I will put the same kind of chart up, that's the logarithmic monthly chart, and we can then see that over this entire time frame, the NASDAQ has done substantially better. Relative to that peak in 2000, it exceeded it in 2016, and since then has gone up 3 times. And that is already accounting for the big decline that we saw in 21 and 22. So what we can then conclude is that the FTSE 100 is what's referred to as a value index. And then the other point is that if we look at the largest holdings, there are really none of these companies are technology companies. And that's not really what they are prized for. But what you do have is a big energy company, a big healthcare company, and a big bank. Then consumer company, oil company, drinks company, consumer company, minor, pharmaceuticals. So if we look at the top 10, there's none of these are technology companies. And this also is helping to support the market in the short term. But there is an additional factor. Why is the FTSE 100 doing well? Well, now I'm looking at just on a line chart, and we're looking at this in local currencies. But if I were to switch it out and then look at this on US dollar terms, well, we're nowhere near an all-time high. The time when the UK market was in fact doing best from the perspective of a foreign investor was in 2006 and 7 because the pound was strong. Then you had a massive devaluation of the pound in 2007 and 8. So from a foreign investor's perspective, the UK market dropped by more than 50% and really hasn't gone anywhere since then. So part of the reason why the FTSE 100 is popping on the upside right now is because the pound is starting to roll over. And we've had a good-sized rebound over the last couple of months. And now it's closing today below the psychological 1.2 area. So this is certainly an indication that the dollar is back on the front foot. And part of the reason for that is because bond yields are still marching higher. So the 10-year yield is up now to 3.5%. And there's a lot of talk in the media that a recession has been avoided in the UK. But how long is that likely to last is, I think, a more important question. Because we know that bond yields are rising, the property market is easing, and there's a lot of uncertainty. And we also know that the wage demand growth is something that the Bank of England looks very closely at. With rising wages and strike action, then it's unlikely there's going to be strong economic growth. And the important point about the FTSE 100 is that none of those companies really rely on the UK for their income. So then they're benefiting from some of the flow as a result. Now, the index that is a better reflection of what's going on in the UK is the FTSE 250. Now, there is a caveat here, of course, in that they're mid-cap companies, so they tend to be more volatile anyway. But it pulled back aggressively between the end of 2021 and the end of 2022. And in that time dropped from 24 to about 17,000, and since then has broken the downtrend. So if this downtrend has in fact been broken, then we're going to see support being found above 19,500. Provided that remains the case, then the UK market will remain on form. Then let's look at some of these other assets, because gold prices have predictably started to roll over. As long as the dollar is strong, then we're going to be in a corrective phase for gold. And it is coming back down now into the region of the 200-day moving average. So this is a potential area of support. Then we should also pay attention to what's happening with oil. So oil prices are a little weaker today, but the bigger picture here is that they continue to steady around the $80 area. And I do apologize for how long this chart is taking to load, but we can very clearly see that the price at the moment is locked in a tight range between the 1,000 and 200-day moving averages. So it's currently pulling back from the upper side of that range. There is still a downtrend in evidence since the peak in 2022. And then we have support in the region of the upper side of this longer term range. So there's a big point of indecision here. On the one hand, we have OPEC and Russia cutting back on supply, which supports prices. On the other hand, we have a slowing global economy which saps demand. So at the moment, this range tells us that supply and demand are in equilibrium. But a breakout either above 90 or below 80 would catalyze a move. Now, if oil prices remain steady, then it would be reasonable to anticipate that the global economy is going to be reasonably healthy. On the other hand, if oil prices pull back from here, it would be an indication that global growth is slowing down in a more meaningful way. Now, ultimately, the lower oil prices go, that helps to encourage economic activity, but it's usually when prices are a lot lower than they are today, and $80 is still reasonably expensive for oil. Now, then let's think about Bitcoin, because we've had a good-sized rally over the last 3 days, and the price got right back up to test the 25,000 level, and that's a new high. So it's the highest level that Bitcoin has traded out to since June. Now, it didn't hold it all today, but the big picture here is that Bitcoin has broken its sequence of lower rally highs, and it is in the process of confirming support in the region of the peak from back in 2017, and it's stabilizing above the 20,000 level. So we might get some additional consolidation. But then the other big thing to bear in mind is that the next halvening for Bitcoin will be in April of 24. Now, The last halvening was in 2020. So let's zoom in then and look at what happened before that. So we had the halvening around May. The price started rallying 14 months before that, had a good sized rally and took it up to break this downtrend. Then we had a period of weakness and the price pulled back rather violently. But then coming into the halvening, which reduces the reward for minting a new block, then prices started to recover. And we saw then a very similar condition in 2016. So prices started to rebound all the way at the beginning of 2015 and had a good sized rally. And then we had a period of boring weakness. And then it was after the halvening that prices really accelerated higher. So it is a time to be start thinking about cryptocurrencies again, even if we're not quite yet at the halvening. And I think with that, I'll leave you for today, and I'll wish all the best to all of you.